In recent years, accounting reporting issues relating to warrants has emerged. This has caused significant losses to businesses and is also causing lots of overtime work for auditors and accountants. As shown in a news article dated back on the 26th of July 2021, special purpose acquisition companies, I'd say SPAC for short, had always treated warrants as equity for years. It was not until the US Securities and Exchange Commission staff announced the reporting errors that SPACs realized their mistake, that some warrants should be treated as liabilities instead of equities. We will explore more about this issue by first starting with an overview of how SPACs raise funds and take private businesses public. Next, Jennifer will explain about the pros and cons of taking companies public through SPACs, followed by Liam, who will explain how warrants are accounted for in the financial reports as per current practice. Then Elena, who will explain the main accounting issue as identified in the US Securities and Exchange Commission statement. To tie it all together, Lance will provide his views on whether the US Securities and Exchange Commission's concerns are valid and whether current accounting practice should be changed. So, what is SPAC? Special Purpose Acquisition Company, or SPAC, is a type of publicly traded company formed strictly to raise capital through an initial public offering with the purpose of directly or indirectly acquiring or merging with a non-listed target company. Moreover, SPACs are generally known in the media as a blank check company due to its shell-like firm structure. SPACs are generally formed by investors or sponsors with expertise in a particular business or industry sector, as their experience and reputation can aid them in identifying a profitable company to acquire or merge with. The timeline of the IPO process carried out by the SPAC is as follows. To start off, the management team of the SPAC hires an investment bank to handle the IPO when it is issued. A fee for this service is typically around 10% of the IPO proceeds, and this is agreed upon by the investment bank and the management team of the SPAC. Afterwards, the IPO is typically conducted by selling $10 units. Each unit is usually made up of one share of stock in the SPAC and a fraction of a warrant, which gives the owner the right to purchase a SPAC share at $11.50 after the SPAC merges with or acquires its target company. Next, the funds raised by SPACs in an IPO are placed in an interest-bearing trust account. These funds cannot be distributed except to complete an acquisition or to return the funds to investors if the SPAC is liquidated, after deducting bank or broker fees. Lastly, the SPAC generally has around 18 to 24 months to identify a target company and complete the acquisition or phase liquidation. During liquidation, the SPAC is dissolved and the IPO proceeds held in the trust account will be distributed to the investors. Hence, this makes SPACs less risky than traditional IPOs. After the merger or acquisition, the target company will be listed on the stock exchange, and this is done without the target company executing its own IPO.
Now that we know how SPAC works, we will look at on the pros and cons of taking companies public through SPAC. The first pros will be the duration. While an initial public offering typically takes 12 to 18 months to make the company public, a SPAC merger often takes 3 to 6 months to finalize the transaction and make the company public. The second one is price determination. Taking companies public through SPAC would allow the company to negotiate the price of the company. Meanwhile, IPO price depends on the market conditions at the time of listing. This means that in a volatile market, it will be much more advantageous to go public through SPAC. The third one is marketing costs. Going public through SPAC would lower the marketing cost of the company, as it does not need to go the extensive roadshow to generate interest from investors in the public exchange market. Next, it is industry professionals. As SPAC sponsors are often experienced financial and industry leaders, they might use their network of contacts to offer management expertise, or they can join the board themselves. After we look at the pros, let's look at the cons. The first one could be company readiness. Although duration is one of the pros of going public through SPAC, The compressed timelines causes the target company to take the brunt of preparing required documents and establishing public company functions such as investor relations and internal controls. Next, it is capital shortfall. In the event of redemptions of initial SPAC investors exceeding expectations, this will then lead to uncertainty in cash availability and would forces SPAC to raise price investment in public equity or PIPE to fill the resulting shortfall. Finally, it is shareholding dilution. The founding shares and warrants owned by SPAC sponsors typically represent a 20% ownership holding in the SPAC. SPAC sponsors also profit from an earn-out component, which entitles them to additional shares when the stock price hits a particular price over a predetermined period, potentially resulting in further dilution.
Now that we know a bit about SPACs, it is appropriate to explore an instrument widely used by these companies, warrants. Warrants are securities providing holders the right, without obligation, to purchase a specified number of securities, such as shares on or before a particular date. As SPACs are not permitted on the Australian Securities Exchange, we will investigate current accounting practice for warrants per US GAAP. In the United States, the recording of warrants is governed by ACCT2542, which provides guidance as to whether warrants should be recorded as equity or liabilities. The codification states that warrants must be recorded as equity if 1. The instrument's settlement amount is the difference between a fixed monetary value and the fair value of a fixed number of the entity's shares, and 2. The instruments qualify for equity classification. These are generally true for most basic and plain vanilla warrants. On the other hand, some warrants need to be classified as liabilities. These include cases in which 1. The SPAC could be required to settle the warrant for cash or another asset. This is irrespective of the likelihood of the outflow. And 2. If the indexation criteria are not met. So what does this look like in practice? Let's see. Firstly, the recording of warrants only directly impacts the balance sheet, and it impacts the statement at 2 key events. The first is at issuance. Omitting potential complexities, the basic journal entry here is to debit cash and credit the warrants account, or warrants outstanding if a liability, but for simplicity, I'll just call both warrants. On the right, the pink arrows represent the movements if the warrant is recorded as equity, whilst the blue represents if they were recorded as a liability. The second event occurs after de-SPAC transaction, which is the consolidation of the SPAC with the target business. This event could be the exercising or lapsing of the warrant. If the holder opts to exercise it, the warrant and cash accounts will be debited, whilst the common stock and additional paid-in capital, or APIC, will be credited. Once again, movements can be observed to the right. If it lapses, however, meaning the holder chose not to exercise it, there will be a debit to the warrant account and a credit to APIC. Thus, under US GAAP and the FASB Accounting Standards Codification, the treatment of warrants as either equity or liabilities is dependent upon their attributes.
Now, the main accounting issues identified in the statement is separated into 3 segments. The first is indexation, in which contracts such as warrants should follow the guidelines considered in GAAP and ASC 815, 4015, 7E to be either classified as an asset, a liabilities, or an equity. In an equity classification, instrument must be considered indexed to the stock by calculating its settlement amount, which includes its fixed price, as well as considering possible variable factors guidelined in the rules, which includes examples such as strike price, the term, and maybe interest rates, etc. The current practice identifies most warrants as equity and some as liability. However, warrants issued by the SPAC includes a variable factor of provisions of possible changes to the characteristics of holder that impact the cash settlement amount. As the holder characteristics is not identified in the rules and the guidelines, it is argued that this aspect would preclude warrant to be identified as an equity, but rather it should be identified as a liability measured at fair value, which is to be revalued at each period. The second segment is a tender offer provision. GAAP's principle outlined that if an uncontrollable event require a net cash settlement, then the contract should be classified as either a liability or an asset. An exception to this is whether if that cash settlement payment pays the holders of the shares, then it is still possible for that contract to be identified as an equity. During the evaluation, SEC presented that the current warrant terms, well, given that a cash tender offer, which is outside of the firm's power, occurred, all warrant holders have the entitlement to the cash, whereas only some shareholders are entitled to the cash. With less priority to the shareholders, SEC states that warrants should be required to be labeled as a liability measured at fair value. Now, the final aspect is the registrant filling considerations. In this part, if an evaluation determined the warranty to be an accounting error, the company should consider some circumstances. Firstly, the Securities Exchange Act 1934 generally require amendments for misstatement in the financial statements. Thus, the error from the warranty may impact a number of the entity's previous reports to be amended according to the appropriate guidelines. This would include revising the information based on that misstatement, such as the analysis, the elaboration regarding the information, and other associated information. Now, furthermore, this should further encourage the entity to reevaluate and strengthen the controls over the reporting and the procedures, which may aid the entity to mitigate actual misstatements and prevent potential errors or deficiencies. Overall, these are the accounting concerns raised by the SEC regarding the specific circumstances of warrants in SPAC.
So now, are the SEC's concerns justified? Before we do this, we need to first define what liabilities and equity are. Liabilities are defined as future obligations arising from past events, potentially leading to the outflow of economic benefits in the future. In comparison, equity is defined as the residual interest in the assets of a firm upon having subtracted its liabilities. Now, in order to define whether a financial instrument is either equity or a liability, it must pass two specific conditions. These conditions are in particularly focused for derivative instruments. Thus, in accordance with IAS number 32, now part of IFRS number 9, the first condition is that there should not be any contractual obligation for the firm to deliver any cash or financial asset to the investor. The second condition is that issuers of derivative instruments should settle with a fixed amount of cash or a financial asset in exchange for a fixed amount of equity instruments. However, the warrants of a special purpose acquisition company fail to meet both of these standards. And as a result, we believe that the SEC is correct in bringing up these concerns and suggesting that warrants be classified as liabilities. One reason for this is the potential for a cash outflow obligation in the scenario of unforeseen events. Furthermore, it fails the so-called fixed for fixed test due to the warrants not being indexed against the share price of a firm, but instead being dependent on variable factors such as the investor themselves. Two other key reasons as to why the SEC's decision to classify warrants as liabilities is correct is that it creates greater accuracy in a firm's financial statements. This is due to the need to continually revalue the warrants of a special purpose acquisition company, leading to greater accuracy in regards to balance sheet. Lastly, it ensures that the accounting for warrants is in line with the US generally accepted accounting principles and the IFRS.